Recently, in the Thar Desert of Rajasthan, a massive military exercise was conducted under the guidance of the Indian Army. Cannons, missiles, combat aircrafts, we saw them all. Along with displaying the military might, this exercise also showed India's shifting focus towards made in India weapon systems. The goal is to become one of the largest defense manufacturing hubs in the world within the next few years. So this could be a money-making opportunity for investors in the defense sector, and brokerages are already recommending many stocks. So today we are going to have a look at some of the companies from the defense sector which can benefit from the policies. And one of them is easily my favorite, and I'm going to explain why. Namaste and welcome to Retail Investing. In the summer of 1999, the entire nation was caught up in the frenzy of the Cricket World Cup. But at the same time, at the western border, a storm was coming. Our most notorious neighbor planted infiltrators, guised as Kashmiri militants, deep inside Indian territory. The Indian military's plan was to bomb them from the air, take back those territories fast without casualties, and maintain the status quo. But for that to happen, GPS coordinates were required. Now the GPS, being owned by the American government, was denied to India. You see, at that time, the relationship between America and Pakistan was quite romantic. But that event changed India's defense policy forever. The need for self-reliance was felt very strongly. And as a result, by the year 2013, India's own version of the GPS was developed partially. 11 years in the future, today, the domestic defense industry is looking more vibrant than ever, with a lot of companies rising up and giving multi-bagger returns to investors. In the first week of August, a video was uploaded on this channel. We discussed 3 stocks from the defense sector. Mazagaon Dock has gone up 38% in the last 9 months. GRSE has doubled in the last 9 months. And Cochin Shipyard has gone up 4x in the last 9 months. Now, I did not expect that kind of returns in such a short time, but the defense sector felt like a common sense bet. But in this video, we are not going to discuss those stocks. Instead, we are going to have a look at some of the stocks recommended by the brokerages. This one is a monopoly business in the domestic market. And here is the chart. The current market price is just under 4,000 rupees. And there is a difference of about 1,000 rupees from the 200-day moving average. And by the way, this gap, it was not a correction. It was a stock split. So here is the financial overview. So it's already a huge company with a market cap of 2.6 lakh crore rupees. In the last 12 months, it is up by 300%. It is a zero debt company, which is always very nice. Now, one thing to notice is that the cash cycle is very long, almost 1.5 years. Now, understanding the cash cycle is important here. So it's a quite simple concept. The company spends money to build inventory, and at some point in the future, the inventory is sold to get the cash back. This period is called the cash cycle. The shorter it is, the better. And the longer it is, the higher the risk. Money getting stuck in the operations for 1.5 years without earning any interest is definitely not good. So here we have the summary of the profit and loss statement. The sales have been growing, and that's okay. Now here we can see that the return on equity has been consistently very good. Now, as per the guidelines of the Department of Public Enterprises, one of the objectives of the PSU companies should be 20% post-tax return on equity, and HAL has clearly over-delivered so far. So HAL's main customer is the Indian Air Force, and the only way to keep getting revenues is to keep the Air Force happy. Now, the Tejas Mark I aircraft was supposed to replace the MiG-21s, which are, by the way, prehistoric aircraft from the 1960s. But still, there are around 50 operational MiG-21s and only 30 odd Tejas Mark I aircrafts were brought into service. This is probably because the Air Force did not like the Mark I version. But the Mark 1A version is changing the game for HAL. There are already orders for 180 aircrafts, and adding the maintenance and overall services of these aircraft which will be essential in the future, HAL can be expected to get a lot of revenues. Plus, they're also diversifying into civil/commercial aviation. Now, there are a few risks which should be considered by investors. The aerospace industry is capital intensive. It requires a lot of investments, and budget constraints might create problems. Secondly, there is still a lot of dependence on foreign OEMs, and that creates a possibility of future supply chain issues for the maintenance and overhaul services. And lastly, it depends primarily on one customer, which is the Indian Air Force. So this company got listed on the stock market in December 2021, and since then the stock has gained almost 400%. The company's products and services find applications in satellites, radars, electronic warfare, and many more. So here's the financial overview, and by the way, it is a private sector company unlike HAL, which is a PSU company. So it's a pretty small company with a market cap of only 17,000 crore rupees. A lot of potential for growth. There is almost no debt, but the cash cycle is 628 days, which is close to 2 years. Now here is the summary of the profit and loss statement. The sales are growing well. An operating profit margin close to 40% is impressive, but the earnings per share growth is not consistent. The return on equity is okay, but not as good as HAL's. It falls short of the 20% target set for the PSU companies. Now if you look at the shareholding pattern, we will notice that recently both domestic and foreign institutional investors have increased a lot of stake in the company. Right now the sentiment around this stock is quite bullish, and overall things are looking good. Now there are a few weaknesses. This is not a PSU company from the defense sector, it's a private company, and competition from other small private players can be a threat. Now secondly, the excessively long cash cycle is a bit concerning, and for a private company in this sector it is riskier than the PSUs. And thirdly, the current price makes it a little expensive. This one is easily my favorite stock from the defense sector, and I'm going to explain why in a moment. So here is the chart. In the last 12 months, the stock is up almost 2.5 times. The current market price is 239 rupees, and the 200-day moving average is at 170 rupees. The daily trading volumes are just huge. So how do they get their revenues? Well, they do some high-tech stuff, and their products are in high demand. Electronic warfare systems, anti-submarine warfare, sonar, tank electronics, and recently they diversified into arms and ammunitions. In the non-defense segment, they make the controversial EVMs and VVPATs, which by the way cannot be hacked. So here's the financial overview. It's a large company with a market cap of around 1.75 lakh crore rupees. Almost no debt, which is excellent. The cash cycle is much shorter than some of the other stocks, and that's why it is my favorite one. Now the return on equity has remained above 20% as per the Department of Public Enterprises policy. Now the future prospects of Bharat Electronics are looking really good because it provides a wide variety of high-tech equipment to the Army, the Air Force, and the Navy. Now based on the current prices, these three stocks do not look cheap. Now many stock market experts are expecting some sort of correction after the election results are out. So it could be a better option to wait for a while. The industries of defense and space are called strategic sectors. Investors need to understand a few things about a strategic sector. Now, firstly, they are mostly under government control, which means high entry barriers resulting into less competition. Secondly, instead of things like consumer spending and demand, it is national strategy that decides the fate of these industries. And thirdly, innovation in these industries will have an impact on other industries and firms. A big advantage of investing into strategic sectors is that they are more resilient to economic shocks. This was clearly seen 4 years ago. The COVID pandemic in 2020 was a major shock to the global economy, and all nations' economies got hammered. But if we look at the defense spending trends during COVID times, there was no slowdown. In the year 2020, global defense spending actually increased by 2.6%, and India's spending on arms procurement was over 18.6% than the budgeted amount. Over the next 5 years or so, India is expected to spend more than $130 billion on fleet modernization. Now, based on these things, some defense companies feel like common sense bets. No high IQ required. The three largest militaries excluding India are USA, Russia and China. None of these countries is ever going to buy weapon systems from a foreign country. So the largest markets are not even an option for exports. India has a military/geopolitical strategy called the necklace of diamonds, and it is meant to counter China's string of pearls. Now that's where India's circle of influence lies. Defense exports to these nations and some other nations are expected to double in the near future. But still, domestic military demand is going to decide the fate of the defense sector, and the domestic market is enough. The stocks we discussed might get recommended to you via WhatsApp and Telegram channels. You can use this video as an input to your decision-making process, but definitely not as a recommendation. From the Indian perspective, weapons are not tools for waging war, but they are the essential instruments for maintaining the peace. Because we live in a rough neighborhood. So I am quite bullish on the defense sector. And you, please take care.